Millions of empty apartments, entire ghost cities lit up at night with almost no one living in them. For decades, Chinese families believed buying property was the safest path to wealth and security. Today, many are watching the value of their life savings evaporate. But the most alarming part is this: China's housing crisis is no longer just China's problem. It is quietly slowing global growth, shaking financial markets, and threatening the future of the world's second-largest economy. So here's the question: can China still save its property market? Or has this crisis become too big to stop? For more than 2 decades, real estate was China's ultimate wealth machine. Families poured their savings into apartments. Local governments relied heavily on land sales. Property developers borrowed enormous amounts of money to build vast new cities and residential projects. At its peak, real estate and related industries accounted for nearly a quarter of China's GDP. What once fueled China's economic miracle, however, has now become one of the biggest threats to its future. The trouble began in 2021 when Beijing introduced the Three Red Lines policy, designed to reduce excessive borrowing by property developers. The government wanted to cool speculation and prevent a dangerous asset bubble. Instead of a soft landing, the market entered a downward spiral. Evergrande, once one of China's largest developers and a symbol of the country's rapid growth, defaulted on its debts. Soon after, other major developers such as Country Garden, Kaisa, and Shimao faced severe financial distress. Thousands of housing projects stalled. Millions of buyers who had already paid for their homes found themselves waiting indefinitely for construction to resume. Confidence began to collapse, and confidence is everything in a housing market. The problem is that real estate in China has never been just about having a place to live. For hundreds of millions of families, property became their primary store of wealth. In many cases, apartments represented the majority of a household's net worth. When home prices started falling, families suddenly felt poorer. Even if they never sold their homes, the decline in value changed their behavior. People spent less, saved more, and became increasingly cautious about the future. This is one of the key reasons why the crisis has lasted far longer than many economists expected. For years, Chinese households believed property prices could only move in one direction, up. An apartment was not simply a home. It was an investment, a retirement plan, a symbol of social status, and often a prerequisite for marriage. Then the bubble burst. Since the market peaked around 2020, trillions of dollars in property value have disappeared. In some regions, house prices have fallen dramatically from their highs. Imagine purchasing an apartment for $500,000 during the boom years. A few years later, that same property might be worth less than half its original value, while the mortgage remains largely unchanged. For many families, this has become a financial nightmare. The effects extend far beyond homeowners. Mortgage boycotts emerged in several cities. Banks became increasingly concerned about rising bad loans. Local governments lost crucial revenue from land sales. Construction companies struggled to survive. A massive chain reaction began spreading throughout the economy. Perhaps the most striking symbol of the crisis is the rise of China's so-called ghost cities. Across the country, enormous residential complexes stand largely empty. Rows of high-rise apartment buildings stretch across the skyline, yet few people live inside them. These developments were built on a simple assumption: China's population would continue growing, urbanization would accelerate, and demand for housing would remain virtually endless. That assumption no longer holds. China is facing a rapidly aging population. Birth rates have fallen sharply. Young people are increasingly pessimistic about their economic prospects. High youth unemployment and slower wage growth have made homeownership less attainable for many families. This is what makes the current crisis fundamentally different from a typical real estate downturn. In many countries, housing markets eventually recover through population growth, rising incomes, or renewed demand. China, however, is confronting a structural challenge. Its population is shrinking, its workforce is aging, and the public's confidence in property as a guaranteed investment has been severely damaged. Despite these challenges, Beijing has not given up. Over the past 2 years, Chinese authorities have introduced a series of measures aimed at stabilizing the market. Restrictions on home purchases have been eased in many cities. Mortgage rates have been lowered. Financial support has been provided for selected developers and unfinished projects. The government has also promoted urban renewal programs and affordable housing initiatives in an effort to stimulate demand. Yet many analysts remain skeptical. The fundamental question is whether government intervention can restore confidence once it has been lost. This is where comparisons with Japan become increasingly relevant. In the late 1980s, Japan experienced one of the largest real estate bubbles in history. Property values soared to extraordinary levels before collapsing. The aftermath was devastating. Asset prices declined for years, consumer spending weakened, economic growth slowed dramatically. The result became known as Japan's lost decades. Today, many observers see similarities between Japan's experience and China's current situation. Both countries experienced massive property booms fueled by debt. Both faced aging populations and declining birth rates, and both struggled with the consequences of falling asset values. The difference is scale. China's economy is significantly larger and more deeply integrated into the global economy than Japan's was when its bubble burst. That means the consequences could extend far beyond China's borders. China is one of the world's largest consumers of steel, cement, copper, and countless other raw materials. A prolonged property downturn reduces demand for these commodities, affecting exporters around the world. Manufacturing activity slows, supply chains weaken, global trade feels the impact. The crisis also creates a psychological effect that may be even more important than the financial damage. When people lose confidence in the future, they postpone major life decisions. Young adults delay marriage, families postpone having children, consumers reduce spending, investors become more cautious. Over time, these behavioral changes can slow economic growth even further. This leaves Beijing facing a difficult dilemma. If the government aggressively supports the housing market, it risks creating even more debt and financial instability. If it allows the market to correct naturally, millions of households could experience substantial losses in wealth. Neither option is attractive. This is perhaps the greatest economic challenge China has faced since the beginning of its reform era. Some economists believe the housing market could gradually stabilize in major cities such as Beijing, Shanghai, and Shenzhen over the next few years. These cities continue to attract talent, investment, and economic activity. However, conditions may be very different in smaller cities where housing supply greatly exceeds demand. In those areas, excess inventory could take many years, perhaps even decades, to absorb. That raises a sobering possibility. The crisis may not end with a dramatic collapse. Instead, it could evolve into a long period of slow decline and stagnation, similar to what Japan experienced after the 1990s. And that may be the most dangerous outcome of all. Sudden crashes are visible. Governments, businesses, and investors can react to them. Slow-moving crises are different. They gradually erode confidence, they weaken growth year after year, and they become increasingly difficult to reverse. Today, China is doing everything it can to prevent the worst-case scenario. But the question that investors, economists, and governments around the world continue to ask remains unchanged. Can Beijing truly revive China's housing market? Or are we witnessing the beginning of a prolonged economic adjustment that could last for decades? The answer will not only determine China's future, it may also shape the future of the global economy.